Let's talk about Zscaler. We've covered Fortinet, CrowdStrike, Palo Alto Networks in recent weeks after earnings, but we haven't talked about Zscaler for almost 6 months. We have had discussions surrounding it on our Discord channel. Don't forget, if you want exclusive content and more coverage, check out our Semi Insider, link in the description below. But without further ado, let's talk about Zscaler. There's 3 main points that we're going to be discussing in this video. The first, Zscaler isn't just a software company anymore. 2, what is the rule of 40 and why you should ignore it? And 3, why we haven't been investing in Zscaler stock.
Point number 1, Zscaler isn't a software business anymore, or at least maybe we should say it's trying not to be just software anymore. Let's go through our alphabet soup of cybersecurity acronyms, Casey's favorite part of every cybersecurity episode. Historically, Zscaler is what's known as a secure service edge, or SSE provider. And that little pie chart in the bottom left, SSE is the right-hand wedge. It's a combination of different software services designed to help secure companies in the cloud computing era. That is just one half of what's known as SASE, or Secure Access Service Edge. SASE combines both the SSE alongside more traditional network security hardware services into one big package. This is especially important for large businesses, larger organizations that maybe have a hybrid IT model where they maybe have some legacy operations, maybe some office buildings, maybe a manufacturing facility. And then they also have access to the cloud. Maybe they have even employees that work remotely from home or on the road. How do you secure all of it? That very diverse workforce and that very diverse organizational operation.
This is a controversial statement that I'm going to make. I know that, we know that, but ultimately we feel like there is no moat in software. And as we continue through this episode on Zscaler, you'll see how we can prove this specific point.
Now, this is probably a good time to talk about our video sponsor for today, Aura. It's a really important time to be talking about Aura because hackers have stolen the social security numbers of potentially every single American. Over 2.9 billion records were stolen from national public data, which offers personal information to employers, private investigators, staffing agencies, others doing background checks. Now, these stolen records include a person's full name, address, date of birth, social security number, phone number, all sorts of personal information. And members of the hacker group have reportedly released this information for free on the internet.
This news is super troubling. I know we've had our credit card information stolen, and that was a hassle to get taken care of. I can't even imagine what's going to happen when it's your social security number. But if you were taking precautions with your personal information online before this kind of thing should be a huge wake-up call. You've never been more vulnerable online than you are right now. I'm not too worried about it because I have started using Aura. Aura alerts me if they find my phone number, email, or social security number on the dark web. They're going to let me know fast if anyone tries to use this information to access my credit or bank accounts. They also give us up to $5 million in identity theft insurance should the worst case scenario happen. They also provide a bunch of other features to keep you safe online, all inside one single app. You can go to our link at aura.com/chipstockinvestor to try 14 days for free. That will be enough time for Aura to find out if any of your personal data is exposed. We recommend that you do this right now because not only is national public data not going to be doing anything about this to help you, it's possible they're not even going to face any repercussions for this leak. We're not leaving ourselves open to data breaches. And if you don't want to either, go to aura.com/chipstockinvestor to try your 2 weeks for free.
Software companies eventually need to branch out into hardware if they want long-term success.
Little known fact, all of the tech giants that some investors think are simply software businesses are not actually software businesses. They combine software with some sort of hardware business, some sort of infrastructure component. And we believe Zscaler is in the beginning stages of doing the same thing. And that is what will build them eventually, if they're successful, into a software business with some sort of moat, some sort of defensible business model. Now, who are some of the competitors that Zscaler is going to bump up against in this networking hardware security part of the industry? Well, here's a little infographic for you.
When it comes to physical location security or firewalls, there's a few big players that we're going to keep in mind. You can kind of ignore the right side of this slide, focus more on the left side. Fortinet, Palo Alto Networks, we talk about them a lot. Check Point and Cisco, also players in this physical location security or hardware. You don't see Zscaler on this list, not yet.
So what is a firewall exactly? Well, this is a networking device that, as the name implies, throws up a wall around a physical location. Let's say an office building. Inside that office, you have workers on computers. They make use of a server that's housed inside of that office building. And then maybe that entire location is connected via some sort of external network connection. Maybe it's a private network and it links up to another office building somewhere else. Or maybe it just hooks up directly to the internet, or it hooks up to a cloud service provider like AWS or Google Cloud or Microsoft Azure. Doesn't matter. That firewall device is what monitors traffic coming into and going out of that local area network. We'll come back to that definition momentarily, but bear in mind that this type of protection is called north-south security, and it monitors data going into and out of a physical location.
There's multiple places where you need cybersecurity protection. Zscaler specifically developed their software to focus on those two there at the bottom in the cloud, public data centers or cloud data centers, and small regional public data centers.
The game really changed, especially during the pandemic, when a lot of organizations around the world suddenly started making use of these cloud services like never before. They had workforces that they sent home and told to work from home. And then suddenly you have this brand new, very large attack vector that needed secured. And so that's where we have these cloud security software vendors like Zscaler that just emerged seemingly out of nowhere. They had their IPO prior to the pandemic, but they had this massive growth spurt from 2020 through 2022 as lots of companies were sort of force shoved into these cloud environments and then suddenly needed software to protect access to these applications and data floating around in the cloud as a result of these lockdowns.
Zscaler is a software company, but you still need hardware in order to provide cybersecurity. This is when Zscaler needed to partner with a hardware provider like Cisco.
And so up until this year in particular, if Zscaler wanted to offer a larger organization the full SASE package, Secure Access Service Edge, that's the software service component that Zscaler itself has developed, as well as the networking security hardware, like a company Cisco provides, or Fortinet, Palo Alto Networks, Check Point software, so on and so forth, Zscaler needed to get help. But of course, Zscaler, being a software provider, doesn't want to necessarily partner with one of its competitors on the software front. Fortinet, Palo Alto Networks do both these days. They have both network security and they have software security. Cisco kind of does too. They've been making lots of software acquisitions in recent years, but historically, Cisco is a network hardware provider. So to get the full SASE package, wide area network hardware, along with the software, Zscaler got some help. But things are starting to change. In January this year, this was very quietly announced. We did not see this covered very much, but Palo Alto Networks in recent years kind of rose to the top as the best SASE provider, hardware and software all in one convenient package. Zscaler announced it was getting into that game as well. And how do you do that? If it's your SASE service in-house, it's all you, well, you need to actually start offering hardware, don't you?
And here that hardware is. Nick, how many shareholders do you think have seen this picture?
Among retail investors, I would venture to say probably not too many.
Yeah, Zscaler definitely touts itself as a software-only provider. We'll discuss that a little bit more as we talk about the rule of 40, as we mentioned is our second point, but they definitely have needed to start upping their hardware business in order to create that moat.
And so in addition to the announcement that they were going to begin providing these network security appliances for branch offices, for physical locations, a few months later, in early April, Zscaler announced this acquisition of another software business, AirGap. Now, AirGap is a cloud software provider. It's subscription-based, but under the surface, there is an actual hardware business designed for physical location security. Again, all of this is to say Zscaler is looking for ways to up its game in SASE. Now, they're trying to do so in a differentiated manner. They're not necessarily pushing network hardware on all of their customers, but that is an option. Another option is maybe you get this network security hardware as a service through this AirGap acquisition.
Let's go back to this slide from Zscaler. Looking at that circle there on the bottom left, Zscaler used to be only the right portion of that circle, the SSE, Security Service Edge. And now they're trying to branch out into the other side of the circle, the left side, to wide area network. Let's talk about some more acronyms. What is a wide area network versus a local area network?
So in order to provide wide area network security, Zscaler actually had to get into local area network security appliances. That's where those hardware appliances we showed you a picture of come into play. Again, SSE, Security Service Edge, is just a software package that reroutes data through the Zscaler exchange, cloud exchange, and allows an organization to enforce rules for that data as it travels through the internet. But what about security locally? You have these firewalls that historically protect something like an office building, but there is an attack vector there. If a cyber attack is able to get into that local area network, you need some way to secure what's called east-west data traffic. So that's maybe data moving in between the computers and in between those computers on premises with the server that's somewhere in the office building. If a bad actor can infiltrate that, they can get access to all sorts of data. So in order to help cover this very critical spot in an IT infrastructure, Zscaler, again, the point here is branching out of just software only and getting into more of a hardware-based business. And you can, of course, see that show up in the statements of cash flow.
Capital expenditures for Zscaler have been on the rise in these recent quarters. You can see that it's all the way up to nearly 50 million in capital expenditures. And that stems from Zscaler realizing that they need some hardware to build this business out. This brings us to point number 2, the rule of 40.
Okay, you've heard this stated on lots of cybersecurity business conference calls. The rule of 40, very simple. It's just the revenue growth rate plus the profit margin, which is actually EBITDA, earnings before interest, tax, depreciation, and amortization. What is the rule of 40 exactly? Well, this is something that has its roots in the world of private equity, in venture capital, in Silicon Valley. It's typically used by portfolio managers that invest in startups, and maybe they have many dozens of startups, and they use this rule of thumb to figure out whether they should continue to invest or give money to these startups. And the rule is, if revenue growth plus the profit margin on an EBITDA basis is greater than 40, they're still worthy of receiving cash. They're still worthy of receiving your support as a venture capitalist.
Now, this has come up on earnings calls with CEO Jay Chaudhry many times. In fact, he mentions the rule of 60. Notice what he said in this recent earnings call. He said, for the full year, revenue grew 34% and free cash flow grew 75%, resulting in a free cash flow margin of 27%. Let that sink in a second. 34% revenue growth, 27% free cash flow margin. and he says they exceeded the rule of 60 for the fourth consecutive year.
Pretty easy. 34 plus 27 equals 61. The problem is Chaudhry used free cash flow margin, not EBITDA margin. Zscaler actually, when using the metric correctly, has not achieved the rule of 60. They haven't even achieved the rule of 40. Their EBITDA margin for fiscal year 2024 was actually negative 2%. So 34 minus 2 is 32. This is just an important thing that has just been bothering me, I think I would say in particular, because a lot of new investors, so new that in fact that they may not have even lived through the 2021, 2022 cloud software boom, have begun regurgitating these rule of 40 and rule of 50 and rule of 60 numbers from companies like Zscaler and saying this is a reason why you would buy the stock. A couple of issues with this. First of all, if you're a retail investor, you're probably not a venture capitalist. You probably don't have a portfolio of dozens and dozens of startups that you're trying to manage and figure out who to fund with your cash. Second, Zscaler is not a startup anymore. It's a publicly traded company. And third, as we already explained during the first half of this video, during our first point, Zscaler is not a software business anymore. They are branching out into new types of business that requires a different business model. The rule of 40 was designed for startup software companies in particular to measure their efficiency at growing via development of product and sales and marketing. The problem with using free cash flow as a metric is that it excludes stock-based compensation to employees. Stock-based compensation is a key marketing expense and a key research and development expense that you pay your sales team and that you pay your developers to keep them planted, to keep them staying at Zscaler versus going to another rival software company. So you can't use free cash flow to calculate the rule of 40 or the rule of 50 or 60 or whatever rule of XX number you want to pick. It doesn't work.
If you have any doubt on how this works out for a software company like Zscaler, software plus hardware company, now here is the stock chart since 2020, mostly sideways.
Okay, so this discussion of the rule of 40, or in Zscaler's case, the rule of 60, leads us to point number 3. Why haven't we been investing in the stock? Because as you probably know, we do cover Zscaler, we do follow the business. It really has emerged as one of the big 4 in pure play cybersecurity businesses. Palo Alto Networks and Fortinet being the really big legacy network hardware providers that have branched out into software. And then you have CrowdStrike, born and raised in the cloud and expanding further and further into more ancillary software services. Zscaler kind of been doing the same, but also going the other direction and getting, it seems, a bit more into network hardware. The reason why we haven't been investing in this 4th business among the biggest pure play enterprise security businesses is you have this revenue growth slowdown that has been ongoing for quite some time. Now, this does exclude the reacceleration of revenue that Zscaler enjoyed in 2020 and 2021 when the world went on lockdown. We actually used to own Zscaler in 2019. This problem was cropping up at that time and we sold. And now here we are 5 years later, the problem has reemerged again.
Yeah, there's a significant deceleration in revenue growth, 34% in fiscal year 2024. And the expectation for full year 2025 revenue is right around 2.6 billion, which would imply a 21% year over year growth. Pretty significant drop in revenue growth over these last 2 years. The other issue with Zscaler stock is that the share count continues to increase. The current guidance implies another 2.6% increase in shares. So this increase in share count and a deceleration of revenue growth causes a bit of a problem in our mind.
We are perfectly fine with a company that is starting to mature and is slowing down. However, as a company starts to decelerate, we would expect that there's a flip from, okay, we're still doling out lots of stock-based compensation to management and to the sales team and the development team, and instead start pivoting to we're lowering the share count. Because what happens as the company decelerates in growth, they have been growing their free cash flow at a pretty good pace the last few years. However, we can't expect 75% year over year increase in free cash flow for much longer. And so now when you have that share count rising and free cash flow growth also decelerating, what you get is this in the following slide. You get some pretty choppy results in free cash flow on a per share basis.
The free cash flow per share has been at a 19.5 compound annual growth rate since 2021, which is very good. But you can see that it has been a little bit lumpy, and we expect it to get even worse in coming years.
And this is just another sign that the business is maturing and it needs to change the way it funds itself, the way it funds its operations. They did take out some debt this last year. Some of that was to fund the acquisition of AirGap that we discussed earlier. But you no longer have this squeaky clean balance sheet with tons of excess cash and short-term investments on balance. The introduction of debt, a little over 1.1 billion as of the end of fiscal 2024, is just a sign that management, in fact, does expect the growth rate to be far lower than it has been the last few years. So again, you pair that with a rising share count, it really dilutes shareholders. Stock-based compensation isn't the end of the world, but in this case, we feel like it is way too high given where the business is at in its current life cycle.
On the valuation for Zscaler, it is getting cheaper. You can see on a forward basis, price to earnings 53, 54x, and on a forward price to free cash flow, around 37 to 38x. It has decreased, but it's still not cheap.
Now, this isn't to say the stock won't rally off of this base after the latest earnings and the stock cratered again. In fact, it has done that in recent years. The stock has been in this, as Casey mentioned earlier, sideways range for the better part of 4, almost 5 years now. And a lot of investors get lured back in after these post-earnings plunges, the stock rallies, and then it seems like in another quarter or two, there's another round of disappointment and the stock falls again. So this isn't to say the stock isn't cheap and that it won't rise from here, but until the business model undergoes a more robust transformation from all-out software growth to more mature business that combines software and hardware and adjusts the way it funds itself, well, we're kind of just sitting on the sidelines still at this point.
Cybersecurity is very much a secular growth trend, and we're happy to be invested in cybersecurity companies. We do have a cybersecurity basket of stocks. As Nick mentioned, Palo Alto Networks, Fortinet, CrowdStrike are all in our portfolio.
But at this point, given some of the issues that we've explained in the past and that seem to continue to crop up here every quarter for Zscaler, this is one that we just see no need at this point to add to that basket. I should probably also mention too here, Casey, in addition to the pure play cybersecurity companies, if you own big tech, if you own Microsoft or Google or Amazon, AWS, whatever, you also do get a little bit of cybersecurity in the mix with owning those. Many of those companies own cybersecurity services in-house. And so if you're looking to bet on the cybersecurity secular growth trend, you could call it good with owning just some of the big tech stocks that are part of the Magnificent Seven.
Thanks for tuning in today, everyone. Make sure you sub to the channel and check out our sponsor for this video, aura.com/chipstockinvestor. You can find the link in the description below. We have been enjoying using Aura, and you might too. You can get a free trial for 14 days with our link in the description below. See you all again soon at Chipstock Investor.